According to a new AM Best report, average annual rate increases for U.S. private passenger auto and homeowners policies shifted back to pre-pandemic levels in 2025, following years of large increases amid elevated losses in each line of business. The average rate increase for private passenger auto policies dropped off 6 percentage points to 3.7% in 2025 compared with a year earlier. For homeowners, the average approved rate increase was 8.3% in 2025, significantly less than the 13.5% level registered in 2024. We're joined today by two of the authors of this report, Associate Director David Blades and Associate Analyst Dylan Catania. And David, we're going to start with you today. If we could start with some of the background here, what spurred along this review of best state rate filings data with respect to these two personal lines?
Well, John, the fact that AM Best has this state rate filing database, that's really what spurred on this analysis in terms of the fact that we have the data. We've actually used it in previous years for here and there for different exhibits on our reports, but this is the first time that we've actually focused on the information out of the state rate filing database for a specific report and to give insights to our AM Best customers. So then thinking, all right, what's the best way to present this information? We know that over the last couple of years in particular, about half of the inquiries that we've gotten from reporters and from AM Best customers that consume our reports has been focused on the personal lines of business, the private passenger auto and homeowners. It's not surprising because those two lines, as part of the overall property casualty industry, make up about 45 to 50% of the premium, direct premium volume in the PC industry. So it's, again, no surprise that so much focus is placed on those lines of coverage. The affordability and availability of homeowners and personal private passenger auto coverage has really been in the news a lot lately, especially in different states where there's been a lot of carriers have kind of stepped away or kind of modified how much coverage they're providing. So that's one of the reasons why we specifically decided to focus on these particular lines of coverage. Also, from the standpoint of homeowners in particular, over the last, and I won't just say the last several years, it's probably been the last decade or more, we've seen a greater frequency of severe weather events, not just hurricanes, but also secondary peril events, wildfires, hailstorms, tornadoes, floods, and all of those have had a great impact on the homeowners line. So again, that's another reason why there's been so much focus on that as part of the overall personal lines of coverage, and one of the reasons why we decided in looking at and taking a look at the information that we have in our state rate filing facility to focus on these two lines of coverage.
Okay, so you mentioned the homeowners side, David. Were there any trends that were evident with homeowners?
Oh, definitely there were. I mean, going into this, we know from looking at the market, and we do obviously reports every year on all the major property casualty lines of coverage. We knew that the last couple of years, in particular, 2024 and 2025, we saw notable improvement in both the homeowners and private passenger auto lines of coverage. So specific to homeowners, what that's done is it's taken some of the pressure off insurers from the standpoint of needing to push their rates, because again, they've been addressing, over the last 6 years, the last 6-7 years, homeowners has actually been very volatile in terms of profitability. Years from 2018 to 2023, before the 2 years that we studied for this report, in 5 of those 6 years, from the PC industry standpoint, they produced, the homeowners line, it produced a net underwriting loss. So that was sort of the background as we looked at, all right, what's happened in 2024 and 2025 from a rate standpoint. And what we saw is that the steps that insurance companies had taken in those years, or because of the results in those years, especially in 2021, 22, and 23, really pushing for rate increases, what happened is when we looked at the average approved rate change for 2024 and for 2025, as you mentioned, 2024, the average rate change was 13.5%. 2025 was a little over 8%. So it's a 5-point difference in terms of lesser rate need for the homeowners line. And again, that wasn't surprising because we've seen the improvement in profitability. And in 2025, we saw even greater results. Homeowners actually generated a net underwriting profit for the first time in several years. So we would expect on a going forward basis for the 2026 year that we'll probably see more in terms of the trend where, again, we saw the average approved rate change decline in 2025. We probably will see more manifestation of the positive momentum that homeowners insurers have enjoyed when we see the average rate change for 2026. But that's something that we'll continue looking at.
Dylan, how did private passenger fare in this analysis?
Yeah, quite similarly to homeowners, actually. So, I mean, in the last 5 years, those insurers' bids to reach that rate adequacy they've been looking for have finally paid off. In the last 2 years, we've seen significant improvements, and 2024 was actually the first year they posted an underwriting gain in the industry since the pandemic. So big changes there. Now, average rate changes, as we mentioned before, dropped 6 points, which is precipitous. It's pretty extreme. And that's going to be due to, those better underwriting gains and results in the last 2 years. We saw huge improvements in the technology there. And we also saw just more innovative underwriting. So in those techniques. So that ended up bringing down loss and expense severity across the board in the industry. So yeah, similar story.
Right. And to his point, even on the homeowner side, it wasn't just the push for rate increases. It was also insurers pushing for better modeling, revising their underwriting guidelines, and also refining their risk appetite from the standpoint of which states they wanted to write in and then which territories within those states. So it's the improvements have been multi-pronged, but this report focused on how they manifested in terms of the approved rates.
And Dylan, I have to imagine that it's safe to assume that consumers in some states fared better than in others.
We'd hope so, but it's more a matter of when consumers experience the more favorable rates for them. So we saw in Maine, Alabama, Idaho, and Iowa, differences in the rate changes of 10 points or more. From 2024 to 2025, there was a 10-point reduction or more, which is really wild when you look at the data over a long period. And then you have Nevada and New Jersey that actually saw increases in the same period. And so when reconciling that, you actually can see it's more a matter of when the insurers decided to shoot for that rate adequacy. In the states where we saw huge drops in 2025, we see that in 2022, they actually had precipitous rises, where in New Jersey and Nevada and other states that are either increased or stayed about the same from 24 to 25, those increases didn't really jump until 2023 or 24. So we're expecting that maybe in the rest of 2026 or into 2027, these states with the higher magnitudes of changes are going to catch up across the board. So it's a matter of when.
and factoring into that, and Dylan knows this, from a state-to-state basis, some regulatory environments are more arduous in terms of getting the approved or just the whole rate filing procedure. So it's more difficult in some states, to be honest, for insurers to get rate increases or to get rate changes that they feel they need. And again, companies are coming in there with their claim data, and their filings reflect what they're seeing in their portfolios, and they're presenting that to the regulators. But in some cases, it's a little tougher to get through the regulatory process. So to Dylan's point when he's talking about that affects the when, how soon these rate changes can get approved. And then it's still going to take 12 months for each insurance company to have those rate changes work their way through their portfolio. So the when is very important, but the regulatory environment from state to state factors into that when.
And we saw over 100,000 different rate filings, in the period that we were analyzing. And you can see for every rate increase that gets approved, there are dozens that don't. And usually they're not in the similar magnitude that these companies are shooting for, right? So it is sort of a varied effect. And you can see the lag time there that David was mentioning in the data.
I'm sure you'll be keeping an eye on it. Dylan, David, thank you so much for taking the time to speak with us today.
Thank you.
You're welcome, John.
That was Associate Director David Blades and Associate Analyst Dylan Catania. You can find the full report online at ambest.com. For AM Best TV, I'm John Weber.